Before you overpay your mortgage this month, there are 5 checks that matter more than the headline interest rate. Get them wrong, and you could lose thousands. Get them right, and you'll keep flexibility and build wealth. I'm Dan, and today we're settling the debate. Should you overpay your mortgage or invest in 2026? The answer might surprise you. Let's start with the basic maths. When you overpay your mortgage, you're buying a guaranteed return equal to your mortgage interest rate. If you're paying 5.8% on your mortgage, every extra pound you pay saves you 5.8 pence in interest. No risk, no volatility. Certainty. Investing, on the other hand, might give you more. The average stocks and shares ISA has returned around 6.4% over 5 years and 11.9% in the year to February 2025. But, and this is crucial, those returns aren't guaranteed. Your capital can fall. Markets go down as well as up. So if it were just about rates, you'd compare your mortgage rate against expected investment returns. But it's never that simple. Here are the 5 checks you need to make first. Check 1. Do you have high-interest debt, credit cards, personal loans, buy now, pay late balances? The average credit card APR in 2026 is over 22%. That's 4 times your mortgage rate. If you've got £5,000 on a credit card at 22% APR, paying that off gives you a guaranteed 22% return. Nothing in the investment world touches that risk-free. Clear high-interest debt first. Always. Check 2. Do you have an emergency fund? Before you lock money into your mortgage or investments, you need 3 to 6 months of expenses in easy access savings. Why? Because mortgage overpayments are illiquid. Once you've overpaid, you can't just ask for that money back when your boiler breaks or you need a new car. Some lenders let you redraw, but many don't. Cash ISAs are currently paying around 4.5%. Not exciting, but accessible. Emergency fund first, then decide on overpayments versus investing. Check 3. What's your actual mortgage rate and when does your deal end? Not everyone is on 5.8%. If you locked in a 2% deal 3 years ago, overpaying makes much more sense than if you're on 6%. Scenario A. Mortgage at 2%. Overpaying gives 2% guaranteed return. Investing at 6.4% average might be better long term. Scenario B. Mortgage at 6.5%. Overpaying gives 6.5% guaranteed. That's harder for investments to beat after tax and risk segs. Also check, when does your fixed deal end? If you're rolling onto your lender's standard variable rate, currently around 7.15% to 8%, overpaying becomes much more attractive. Check 4. Does your mortgage have overpayment limits? Most fixed-rate mortgages let you overpay up to 10% of the outstanding balance each year without penalty. Go over that and you'll hit an early repayment charge, often 1% to 5% of the overpayment. Example, you've got a £200,000 mortgage. Your 10% allowance is £20,000 per year. Overpaying £200 a month is £2,400 annually, comfortably within the limit. But if you're planning a £30,000 lump sum, check your terms first. Check 5. What's your time horizon and risk tolerance? If you need this money in less than 5 years, maybe you're planning to move or you've got a big expense coming, investing in stocks is risky. Markets can fall and take years to recover, but if you're investing for 10 years or more, history is on your side. The UK stock market has averaged 8.2% annually over the past decade. Over long periods, markets tend to rise. You're being compensated for taking risk and giving up liquidity. Ask yourself honestly, if your investments drop 20% next year, would you panic and sell? If yes, overpaying your mortgage or keeping cash in a high-interest savings account might suit you better. Let's work through an example. You've got £200 per month spare. No high-interest debt. Emergency fund is sorted. Your mortgage is £200,000 at 5.8%, fixed for 3 more years. You've got a 10% overpayment allowance. Option A. Overpay the mortgage, £200 month into mortgage at 5.8%. Guaranteed saves £13,920 in interest over remaining term. Approximate. Reduces monthly payment or term money is locked in. Not accessible. Option B. Invest in stocks and shares, ISA £200 month invested, averaging 6.4% annually. After 10 years, approximately £33,500 versus £24,000 invested. Money remains accessible, can sell units if needed. Value can go down, no guarantees. Option C, split the difference, £100 month overpaying mortgage, £100 month investing, gets guaranteed return. And market exposure builds flexibility. There's no single right answer. It depends on your situation, your risk tolerance, and your goals. Before we wrap up, here are the common mistakes to avoid. Mistake 1. Overpaying your mortgage while carrying credit card debt. That's financial madness. Pay the 22% debt first. Mistake 2. Ignoring your emergency fund. Don't lock all your cash into your house and then put repairs on a credit card. Mistake 3. Breaching your overpayment allowance. Check that 10% limit before you send a lump sum. Mistake 4. Treating investment returns as guaranteed. They're not. Past performance doesn't guarantee future results. Here's your action checklist. Pay off high-interest debt first, credit cards, personal loans. Build emergency fund. 3 to 6 months expenses in easy access savings. Check your mortgage rate and deal end date. Review your overpayment allowance, usually 10% per year. Decide your time horizon, under 5 years or 10 plus years. Assess your risk tolerance. Can you handle market drops? Consider splitting. Some overpayment, some investing. Use your ISA allowance, £20,000 per year tax-free. The mortgage versus investing decision isn't about finding the highest number. It's about balancing certainty, flexibility, risk, and your personal situation. If you're on a low mortgage rate and can tolerate risk, investing might win long term. If you're on a high rate or value peace of mind, overpaying makes sense. And remember, you can do both. This video is for educational purposes only and doesn't constitute financial advice. Your situation is unique. If you're unsure, speak to a qualified financial advisor. I'm Dan. Thanks for watching. See you next time.